So good afternoon, everyone. Thank you very much, Mark, for allowing me to join in. Presentations have been great so far, so I hope I can add to that. I've compressed 2 days worth of information into 15 minutes. So if I rush, do forgive me. I'm very happy to send out, or have Mark send out a copy of the slides. So you don't need to worry about taking notes from my slides. Well, a little bit about me to start off with. I'm a chartered tax advisor, been in the tax profession for 40 years, or a little over 40 years now, which is quite a worrying statistic. I'm the vice chairman of the Kent branch of the Chartered Institute of Taxation, and I commenced my career with PricewaterhouseCoopers in London a very long time ago. I've been running my own practice since 1994. And I'm also a landlord and property developer. My passions are my wife and my son, obviously. Oh, sorry, that's an old photograph. That's the right one. We've been married for 30 years. Our son Caden is nearly 15, running his own business, and my faith and values are very important to me. Education, especially the education of youngsters, is key. And I love property, health, driving, golf, and above all, taxation. Well, not above all. If anyone tells you that they know everything about tax, this is what you should do. Never ever believe that someone knows everything about tax. But I'd like to start by asking you a question. What do you think Hmrc knows about you? Most people don't realise that they know a lot more than just the tax returns that you send into them. For example, have you heard about the Common Reporting Standard or Hmrc Connect? Has anybody heard of Hmrc Connect? Oh, okay, good. Some of you have. Unexplained Wealth Orders, the Investigatory Powers Act of 2016. So under the CRS, all financial institutions are required to report all sorts of information to local tax authorities, which are then shared with over 100 countries across the world. And you can find a list of those. I'll leave a link here for you to look at later. That includes all sorts of different personal information about you, but Hmrc's Connect system goes much further than that. So it's a system that cost £80 million. It allows access to billions of items of data within a few seconds from 30 databases. And it actually won the Best Big Data Project Award in the UK IT Industry Awards in November 2012. So what information do they have? I'm going to just put this screen up for a moment for you to have a quick look through. I think you may be quite surprised by some of them, especially when you think that they have 150 specialists who do this every day. So there we are. I'll give you just a moment to have a look. The air tickets are very interesting, especially in the current COVID issues. They can actually check which seat you were on which plane to which destination. So quite a comprehensive amount of information that they can gather. There are 2 other major sources: your accountant, financial advisor, or tax advisor, because under anti-money laundering regulations, if they have a suspicion that there may be something odd about funding or money movements, they are required to report it to Hmrc. And if they tell you that they're going to, or give you a hint that they're going to, that's an offence called tipping off, and you can go to jail for 8 years. So that's quite an interesting angle. Of course, your tax advisor should always be helping you to get it right in the first place. And then there are those people that just don't like you. In 2016, Hmrc paid nearly £500,000 to informants. And they have a special fraud hotline that anyone who chooses to can call. Unexplained wealth orders, you've probably heard about those. There was a recent case where somebody won against Hmrc for an unexplained wealth order. It's essentially where they can suspect you of having more money than you're indicating that you have, and therefore they can seize your assets, whether they have any grounds to or not at the time. And then the Investigatory Powers Act is really a snooper's charter, which is currently under review, so I won't waste time on that. I am confident in saying that there's never been more chaos and uncertainty in taxation. You've got the departure of Sajid Javid and then the appointment of Rishi Sunak less than a month before the budget, with a backdrop of the COVID-19 pandemic, and then a whole plethora of emergency financial measures. And we still have Brexit to come. Isn't that nice? So we have no idea where we're going with tax legislation, because the black hole will be filled somewhere. And so in the few minutes I have with you, we're going to try and look at some of the key areas that you might want to consider, so you have the ability to use the current legislation rather than what I believe will be the penal legislation coming along. Some basic tax planning. I don't know how many of you always keep your wills up to date. You really need one, and you must keep it up to date. And you should also review the value of everything that goes into the will on a regular basis. It's especially important if you have minor children, if you're unmarried or not in a civil partnership, or you own property as tenants in common. Intestacy should never be an option that you want to take. You can vary somebody's will after their death as long as all the beneficiaries agree to do so, but that can be costly and complicated. So I wouldn't recommend that. You should also have powers of attorney in place, both for your property and financial affairs and for your health and welfare. Because most people think of powers of attorney kicking in when someone loses their ability to think clearly. But what if you fell over and broke both your wrists and are unable to sign any documents? So it's a really important part of your planning for any finances, but particularly tax. Now, do you need a limited company? There's been so much talk about limited companies. If you're self-employed, you can shift your business into a limited company, as long as it's a trading business. And there won't be any adverse tax consequences, as it's an automatic relief. There are, however, additional admin and financial costs to running a limited company. So you should build those into the equation. And also, what type of structure is your limited company going to have? Who's going to hold the shares? Are you going to have alphabet shares, for example, which enable each different shareholder to have a different type of share, an A share or a B share? And you can vary the voting rights and so on to go with those. That has a long-term tax consequence, because when you come to sell the shares, they will be allocated possibly a different type of value depending on what the setup is. Are you actually undertaking any financial risk? There was a court case recently won by the taxpayer because the wife could show that when she was appointed a shareholder, she actually invested some of her own funds and therefore took a financial risk, as opposed to, for example, one spouse just giving some shares to another spouse. Who's going to have the significant control of the company? And is it better to have a group structure where you have a number of different companies linked together? Or is it better actually to have separate companies altogether? Obviously, for VAT purposes, when you transfer your business into a limited company, it's a transfer of a going concern, and therefore there's no VAT liability involved, which is great. Now, we were mentioning earlier Section 24 interest and whether to move your properties into a limited company. I've been shocked at how many people have jumped in to do that. There are just so many factors to take into account, and most of those have been overlooked in much of the press speculation that I've seen. So here are just a few pointers of things that you might want to take into account. It's very difficult to reverse without paying heavy penalties. So do you really want to put yourself in a situation that you can't get out of easily? You may lose capital gains tax exemptions on the way in or crystallize a capital gain. What about losses brought forward? If you have a portfolio of properties and you're carrying a loss somewhere in there, what happens to those? Well, they are lost. What's the history of ownership and how does that affect what you're planning to do? And when you move your assets into a limited company, is it going to be a trading company or an investment company? The tax consequences are completely different for the two. So for example, you lose business property relief if it's not trading. That means it's 100% inheritance tax exemption that you're throwing away. The business asset disposal relief or the old entrepreneur's relief may not apply. And some of the other reliefs also may not be relevant to a non-trading or investment company. And what about future access to funding? I'm sure you know mortgage brokers who are saying actually it's quite difficult to raise certain types of finance for a limited company. And have you considered, rather than incorporation, alternative ownership? So for example, transferring part of the ownership to a spouse. That might be much more beneficial than incorporation. Or you might even want to change your property strategy with the assets that you have. And then there's a hidden tax, which not many people talk about, which is ATED. And that's where a limited company owns UK residential property that's worth more than £500,000. And that then gives rise to an additional annual charge. And then with all limited companies, you have the double tax trap. Yes, you can get the money into the company, it pays its corporation tax, but then how do you get the money out to yourself without incurring a tax trap? And last of all, I'd like to mention this particularly because I think this is where we'll be going eventually. I'm old enough to remember the 1970s and the early 1980s tax regimes. And at that time, they had something called investment close companies or close investment companies and deemed distributions, which meant that you could incur a liability at a rate, a tax liability at a rate of 98%, whether you took money out of your company or not. So if your company had £1 million of profit in it, your tax liability personally would be £980,000, even if you didn't take a penny out. And I think that's where Section 24 comes in, because it's driving a lot of landlords to put properties into companies. And then I've seen it happen many times over the years. The legislation is changed and you're even worse off than you were from where you began. Now, Hmrc hates husbands, wives and children because they are looked at as tax avoidance tools. Husbands and wives have a special standing when it comes to tax planning, but Hmrc is increasingly using settlement legislation to block all of that planning. There are, however, certain avenues that you can still follow, but you have to have a commercial reason for doing it, not just a question of saving tax. And here are some of the things that you may already be doing or you may not have heard about. So certainly you should be using your spouse's basic rate band if it's available, and paying a salary or dividend if that is allowed through your company structure. You can create an interest in the economic benefit of the property and use a type of beneficial trust. You can use an interspouse transfer, which is exempt for capital gains tax, inheritance tax, and income tax. You can use a pension or a SAS, as we were mentioning earlier. You can bring your children on board by forming a family partnership. or forming a management company that's separate to your existing business, and you can take them on as employees. Just beware that capital gains tax on gifts to children would apply, and there may be an inheritance tax consequence if you reserve a benefit. One of the ways of getting around that could be the use of trusts, where you can control the asset, but you are not beneficially involved in it. Now, at the moment, businesses and property values may be suppressed because of everything that's going on. So it's a great time to consider your business structure and how you might want to be planning to pass on your business tax efficiently. For example, are you using the most efficient structure? Is it better to be a sole trader, a partnership, a limited liability partnership, a sole company or a group, or a collection of individual companies? Are you holding your assets in the correct entity? For example, in your own name, in a company or in a trust? Should you reorganize the ownership structure of companies to take advantage of the tax reliefs that are available at the moment? And should you consider the use of trust to hold shares or properties to minimize a number of different taxes? And also, we were talking about earlier how you involve through the pensions employees. You can also get involved in employee share options, particularly if you don't have the cash flow to fund salary increases or bonuses. And can you utilize the business asset disposal relief or entrepreneurs relief before it disappears, which I'm sure it will. Now, if you've been affected by the current situation, you can take some action steps with tax to help your cash flow. So certainly review any loss relief claims that you've made in the last couple of years, or if you're considering or looking at a loss for the current year, look at how best you can use that loss. Have capital allowances claims been maximised? And consider the timing of your capital expenditure so you get the maximum benefit from the expenditure. Include specific bad debt provisions in your accounts. If you can provide a specific reason for a specific bad debt, it's allowable for tax purposes. Do you qualify for cash accounting for VAT so that you only pay VAT when you receive the payment? Should you contact Hmrc to discuss a time to pay arrangement? This applies to all taxes, but there are a couple of things that are automatic. So you can automatically defer your 31st of July self-assessment payment to the 31st of January next year. And you can also defer any VAT due before the end of June to the 31st of March 2021. And you don't need to enter a time to pay arrangement to do that. Would you qualify for a corporate rescue exemption? Now, this is where companies restructure their debt in agreement with the lender. And technically, if you can reduce the interest or write off some of the debt, there's actually a tax charge involved. But if you do it the correct way, there is no tax charge. And is your business eligible for research and development tax credits? Now, a lot of the time people think of this as being a sort of white people in white lab coats dealing with dangerous germs. But this is even if you've put a new system in place that someone hasn't thought of before. The costs of doing that, the employment costs and so on, would all qualify for research and development. Now, I'd like to focus just for a minute on the major change in capital gains tax, especially for people who are disposing of residential property. So since 6th of April 2020, you're required to use the Hmrc capital gains tax on UK property service. And you have to report any disposal of UK property, and that includes a gift or any other transaction. In order to do that, you need a government gateway user ID and password. So if you haven't got one, then you need to get one before the fact. When you use the service, you'll need to upload PDFs or JPEGs showing how your capital gains was calculated and how the tax was calculated. And then Hmrc will send you a letter or email giving you a payment reference and instructions on how to pay. And all of this has to take place within 30 days of completion. You still have to include that disposal in your self-assessment tax return. So you're effectively submitting 2 returns, paying the tax after 30 days, and then if it turns out that the calculation was inaccurate, then you pay the additional tax when you complete your self-assessment return. Now, I'll just mention this briefly. I do have access to something that doesn't cost anything to be involved in, but if you're VAT registered and trading, you can actually reduce your rate of tax from 40 or 60% to the lower rates. And it's a great alternative to salary and dividends or drawings for business owners, because you can actually access the cash without incurring a personal tax liability. So if you want to contact me at some point about that, you're very welcome to. A little knowledge is a dangerous thing. So I'm just going to give you a couple of very quick case studies. A client, Ray, against my advice, transferred a London property into a limited company. He crystallised a capital gain of around about £350,000. That's not the gain, that's the tax. And he landed himself with an ATED charge. And he could just have left things as they were and he would have not suffered either of those. Another client, Tim, came to me as a prospective client telling me the amazing gain he'd realised on improving his Kent barn. And the capital gains tax on that turned out to be about £200,000. But had he gone back and lived in it for a little while, the liability would have been 0. So again, just taking the right advice. And this one brings a smile to my face and then it makes me cry. I had a client who decided the advice I was giving was for bigger companies than hers. And she volunteered tax of £135,000. So thank you very much for your attention and for listening. If you have any questions, then please put them in the chat box and I'll join them. You can look at a couple of videos that are on YouTube. I'll again include these links in what I send out. I'm also happy to send you a copy of our 2020 budget update, which is quite useful. And if you'd like to connect with me, those are my details. The QR code there, if you have the LinkedIn app on your phone, you can go into your LinkedIn app. In the search bar, there's a little box which looks similar to that. Tap on it and it will scan that code and automatically connect with me on LinkedIn.